I just read and read and read. I probably read 5 to 6 hours a day. I read 5 daily newspapers. I read a fair number of magazines. I read annual reports, and I read a lot of other things. By far the best investment you can make is in yourself. I am doing what I love to do with people I love. You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time.
Are you planning to invest in 2023? For your information, 2023 is all about a failing stock market, high inflation, high interest rates, and much more. Are you confused about how to gear up for your investment plan? Investors are never free from risk factors, and times haven't been favorable. Almost all prominent indices are down year over year, and the Federal Reserve has been hiking the interest rates for quite a while now. In such a dilemma, it's better to listen to the strategies of the most successful investor, Warren Buffett. What to do regardless of how unfavorable the economic predictions seem. Fed has been very strict in the financial conditions, disregarding the uncertainty resulting from the Silicon Valley bank collapse and the recent shakeup of regional banks. Last time the economy went into a deep recession when the interest rates were hiked. Therefore, every investor is forced to face this awful economic reality wherein increased interest rates and inflation go hand in hand. According to experts, there are also other large-scale effects due to the increased rates of the economy, such as higher cost of borrowing and reduced consumer spending. As far as an investor is concerned, these trends indicate 3 major aspects. The bond prices will go down, making them more attractive. Higher returns on savings will enable people to go that way, and stocks will have less demand due to their risky nature. To compete with higher risk-free saving rates, every investor has to construct a new plan in 2023. And for that, we should refer to the time-honored advice from the Oracle of Omaha, Warren Buffett, and abide by his algorithm for picking stocks. Warren Buffett suggests 3 major steps to be followed by investors in 2023. Discover and thoroughly study the companies with strong and enduring competitive advantages. Go for bulk purchases at an attractive price when the economics of the business is strong. Hold your investment for the long term. Buffett's proposal may appear simple to adopt, but beyond these 3 steps, he insists on one important component in the investment strategy: temperament. According to him, we can sometimes achieve something only because we have a balanced mind. Processing a sound mind is a requirement in this business. In his 1996 letter to Berkshire Hathaway investors, Buffett exhorted the investors to entirely avoid owning a stock if they are about to panic and sell the stock because of a wrecking market. He also stated that selling fine businesses based on negative news is usually disastrous. Simply, it says that one might buy the right stocks and the right strategy, but lose it all with the wrong temperament. Buffett further explains the 3 philosophical benchmarks in approaching the market: your attitude towards the market, your margin of safety, the ability to view stocks as businesses. Buffett recommends passive investment for those struggling to deal with the market's uncertainties, like what we're experiencing in 2023. Through passive investment, Buffett recommends buying and investing in index funds. Investing in index funds charges minimal fees, ensuring that those following this path will beat the net results delivered by most investment professionals. Buffett advised NBA star LeBron James to invest in index funds as he considered index funds equivalent to maintaining a diversified piece of America for a long period. We can apply this investment strategy over time by dollar cost averaging a part of our income to bring amazing results. A wise investor has to stay calm while saving the investing regularly. By doing this, we are buying stocks at different prices over time, decreasing the risk of market fluctuations. If you're still willing to accept the challenge of setting up an investment portfolio, Warren Buffett seeks your attention to something important. According to Warren, intelligent investing is not complicated, but it's also not easy to be an affluent investor. You need to be able to judge companies within your circle of expertise. It's not a concern how big or small the circle, but it's crucial to know its boundaries. We don't need to be proficient in complex financial theories and concepts. Instead, Buffett emphasizes 2 major areas of focus on being what a company is worth, and the other is one's attitude towards the market. As an investor, your target must be to buy the stock of an easily understandable business for a fair price, whose returns must be higher. When you come across a company that meets these standards, you should purchase a substantial amount of stock and avoid the urge to deviate from your policies. Warren Buffett has proposed some proven steps to stay buoyed even with our miserable economic conditions in 2023. Accordingly, periods of sluggish growth in the market offer the best possibilities to reserve high-quality companies. This fact follows the idea of buying into a market at low prices. What could be Warren Buffett's recommendation for investing during inflation? The fundamental part of Buffett's investment strategy is to view stock as part of a business, which indicates that studying the business before buying their stock is essential. Suppose we apply this tactic in 2023. It clearly states how to invest wisely during inflation. One should ensure that the companies whose stocks are supposed to be bought are well groomed to fit into any inflationary environment. Such enterprises are not generally capital intensive and have the power to fix the market price. But how can we distinguish these companies from others? For instance, take the case of Apple. The company can easily increase its product prices even when product demand is flat. They're not bothered about the significant loss of either market share or unit volume. They can increase prices much more than the competition while maintaining their market share because the demand for iPhones never subsides. Similarly, some renowned brands can afford to increase the pricing of their products during the inflation and still maintain market share. And this is possible only because the consumers are loyal to these brands and are not ready to try out others. The impact of inflation would be very mild upon such companies. The second criteria put forward by Buffett is that a company must have the grounds to accommodate large dollar volume increases in business, which is caused by inflation rather than by real growth. Companies like tech giants can generate more revenue from little investment in this way. Summing up, focusing on the company rather than the general market performance can help you progress as an active investor in the market that is ill-fated by inflation. Buffett also reminds us that the best step you can take in your life to evaluate your earning is to invest in yourself by nourishing your attitudes and aptitudes. The purchasing power acquired as a result of this will help you diminish the impact of inflation on you and your family. The perfect businesses during inflation are usually those to buy only once, and you need not continue making capital investments. Here you are exempted from the problem of continuous reinvestment involving more and more money. During inflation, a huge hype has been given to gold, and many investors believe it's an excellent barricade to fight inflation. As far as Warren Buffett is concerned, buying gold to safeguard the asset is not a brilliant idea, though it seems to be. As claimed by Buffett, gold is a dead asset, unable to synthesize anything. If you're buying it to combat inflation, you're simply speculating that another person will buy it at a higher rate than you did. Isn't it a dumb idea to invest in gold in times of inflation? Do you agree? Now the question remains, how do you invest in times of interest rate hikes? As specified by Warren Buffett, interest rates govern everything. A low interest rate leads to any future flow of earnings from investments worth more money. Generally, a high interest rate creates investments worth less money. We must remember that interest rates are the cost of borrowing money. So a low interest rate makes it easy for businesses to borrow money, which can vitalize the economy and invigorate investments in the stock market. On the contrary, borrowing money becomes a high-cost deal with higher interest rates, which eventually interfere with the rise of the economy and make it more challenging for a business to invest in growth. Investors will think twice before putting their money in stocks, which slashes their value. Moreover, higher interest rates accumulate in bonds and other fixed income investments, which become impressive and reliable to investors because they offer higher returns in stocks with reduced risk. In this case, many investors will move their money out of equities and put them into these other types of investments. This trend may cause stocks to go down. Warren Buffett insists on choosing stocks over bonds for the long term when interest rates are high. Buffett finds it okay to invest in bonds for legal reasons for something of that sort, but he condemns it as stupid to make that a voluntary choice against owning assets. Warren Buffett strongly asserts that equities offer higher potential for growth and returns in a high interest rate scenario than bonds. What do you think about Warren Buffett's suggestions on safe investing in 2023? Did it suit your assessment of market trends in 2023? Please let us know your thoughts in the comment section, and don't forget to hit the like button if you appreciate today's content. Stay tuned for more informative videos. Till then, bye.